There are three great investors: Warren Buffett, George Soros, and Peter Lynch. What does make them so successful, and what do their approaches have in common? In this video, we will analyze the story of each of them, look at the numbers, and find the qualities that allowed them to go down in history as legendary financial strategists. Each of these legendary investors was introduced to the world of finance at an early age, but it's not just about learning about investing. Each of them had already become a full-fledged investor by buying their first stock. Warren Buffett and Peter Lynch did it at age 11, and George Soros bought his first stock at age 14. Even at such a young age, you can see the similarities in their thinking and drive to understand how to make money work for themselves. Remember yourself at the age of 14. Few people at that age think about how to properly manage their finances, not to mention investing. But these three managed not just to think about it, but to successfully realize this idea, laying the foundation for their outstanding careers in the world of investments. Warren Buffett learned one of the most important lessons of his career at the age of 11, which helped him a lot in the future. He bought his first stock for $38, and a few days later decided to sell it when the price reached $40. However, when he later learned that the stock price had risen to $200, the young investor realized that patience and a long-term approach to investing played a key role in success. This lesson became fundamental to Buffett, and nowadays he is associated with the famous quote, "The best time to own a stock is forever." Similar principles about patience and long-term investing are shared by Peter Lynch. He emphasized that investors should be willing to wait, as the market will sooner or later reward those who hold on to their shares. Lynch believed that successful investing takes time and a willingness to be prepared for market fluctuations. George Soros, even though he took a more speculative approach, also made long-term bets on macroeconomic trends. His ability to anticipate changes in the global economy allowed him to capitalize on even short-term fluctuations. For example, in his famous bet against the pound sterling in 1992, he not only analyzed the current situation, but also took into account the long-term economic consequences. This showed that even a speculative investor can use long-term strategies to achieve significant results. So all three investors, each in their own way, emphasize the importance of patience and a strategic approach to investing, which helps them successfully navigate market fluctuations and achieve their financial goals. Warren Buffett, George Soros, and Peter Lynch had a tremendous hunger for knowledge, and each of them devoted years to studying investments to understand how to properly invest their money. They were constantly developing, putting their knowledge into practice, and thanks to this, they became some of the most successful investors in the world. However, not every person is ready to spend so much time and effort to study deeply the market. What to do in such a situation? One of the possible solutions is to use trading robots that will manage your funds regardless of your knowledge level. For example, MiloBot Pro Expert Advisor. This robot is based on a unique strategy that has been developed, tested, and optimized for more than 2 years. MiloBot Pro was first launched in 2019 with a deposit of $34,000. By 2024, its net trading profit was $272,543. You can learn more about the performance of this expert advisor by following the link in the description. There you can also find all information about MiloBot Pro and purchase it on the MQL5.com Trading Robots and Indicators Marketplace. Three legendary investors, Warren Buffett, George Soros, and Peter Lynch, despite their different approaches to investing, often agreed on the choice of companies for their portfolios. Buffett purchased shares of Coca-Cola in 1988 and still holds them in his portfolio, considering the brand as a long-term investment with high stability and stable dividends. Coca-Cola epitomizes Buffett's approach to picking companies with strong reputations, global reach, and longevity. Peter Lynch also saw perspective in Coca-Cola when the company's stock was undervalued in the 1990s. Lynch realized that the brand had tremendous potential due to the global popularity of the products, and he bet on that success. George Soros, known for his ability to capture undervalued opportunities, also invested in Coca-Cola at different periods, seeing it as a global force that could generate significant returns, especially when the market temporarily missed its real value. Another company that has brought them together is Apple. Warren Buffett made high-profile investments in this technology company, seeing it not just as a producer of electronics, but as a powerful business structure with a unique competitive advantage and incredible customer loyalty. George Soros, despite his speculative strategies, was also increasing his stake in Apple, recognizing the trend in the company's products and its ability to continue to hold the market. Peter Lynch was once betting on companies that were still gaining momentum, and Apple, in its early stages, was one such company in his portfolio. These three investors often shared similar views on choosing large companies with a strong brand and a long-term perspective. Besides Coca-Cola and Apple, their investment portfolios often included companies such as IBM, Johnson & Johnson, and Procter & Gamble, each characterized by a global reputation, reliability, and ability to weather market crises. Their interest in such companies demonstrates their ability to find not just temporary trends, but businesses that can generate revenues for decades. Most investors panic in times of crisis and tend to get rid of their assets, but Warren Buffett, George Soros, and Peter Lynch see crises not as a threat, but as an opportunity for significant success. These three legendary investors were distinguished by their ability to use market volatility to their advantage. Warren Buffett in 2008, when the world economy was going through a severe financial crisis, not only did not leave the market, but also made bold investments in companies such as Goldman Sachs and General Electric. At a time when other investors were getting rid of their assets, Buffett saw the future of these giants and bet on their recovery, which brought him huge profits later on. George Soros became famous for his strategy in the market during the 1992 crisis, when he predicted the fall of the British pound. His famous bet against the pound not only earned him over $1 billion, but also became a symbol of how crises can be used for big gains if one is able to analyze global macroeconomic trends. Peter Lynch also used crises to find undervalued assets. He believed that in times when most investors are scared and sell stocks, you can find real treasures that will bring profits in the future. Lynch repeated more than once that the best investment opportunities come precisely during market downturns, when fear takes over rational thinking. All three great investors, Warren Buffett, George Soros, and Peter Lynch, demonstrate to us that success in investing does not depend on short-term trends or panicked decisions. They are united by a unique ability to see opportunities where others see threats and to focus on the long term rather than momentary volatility. Buffett uses his philosophy that the best time to own a stock is forever. Soros capitalizes on global macroeconomic changes, and Lynch always finds value in undervalued assets. All three are not afraid of market volatility, but instead use it to achieve outstanding results. Their examples show that the real power of investing is about patience, the ability to analyze, and most importantly, the willingness to see opportunity in a crisis when most people step back. These three investors left an indelible mark on the world of finance, and their strategies remain relevant today.